The Federal Reserve's hidden card is quietly harvesting the world. America's strategy is to rely on its deep pockets and strong technology, betting that other people's economies will collapse before mine. As long as it can wait until global capital completely returns, or rivals explode first, it can restart the rate cut cycle and complete this century's grand reshuffle unscathed. Actively draining liquidity, what is the US after? Many think the Fed's tightening plus deleveraging combo is self-destructive, causing pain for its own economy and financial markets. But in fact, this is a precisely calculated, targeted demolition. Actively creating a liquidity crunch has four major benefits critical to national destiny. First, creating a global dollar shortage to complete a nuclear-level harvest. As long as US interest rates are high enough and dollars are scarce, global capital will flee emerging markets and flood back to the US for safety or high yields. This is essentially using the world's blood to fill its own gaps. Countries with heavy dollar debt see their currencies plunge and debt double, with core assets dropping to bargain prices, waiting for Wall Street to bottom fish. Second, forcing abscess squeezing to free up resources for AI giants. In the zero-interest rate era, zombie companies that can't even pay interest are everywhere. Through deleveraging, these inefficient companies without self-sustaining capability are eliminated. After their bankruptcy, resources quickly concentrate in the hands of Nasdaq giants like Microsoft and Nvidia, completing a brutal transformation of growth drivers. Third, retaking pricing power to suppress inflation and rivals. When dollars flood the market, commodities skyrocket, and resource-exporting countries prosper. The Fed's strong pumping blows up Wall Street's long leverage, triggering panic selling of paper commodities. Forcing down energy and raw material prices suppresses domestic inflation and heavily strikes geopolitical rivals. Fourth, defending the final line, dollar credit. Facing sky-high debt, if they simply print infinite money, the dollar's purchasing power will visibly collapse. The current tightening is a performance for the world. I'd rather cut off my own arm to defend the dollar. As long as people believe the dollar is still hard currency, this game of hot potato can continue. 2. The cost of walking the tightrope, 4 fatal backlashes. This maximum pressure play is essentially walking a tightrope. While it can harvest wealth in the short term, it brings extremely tragic side effects, the most uncontrollable risks in current macroeconomics. First, debt backlash, a black hole consuming the budget. High rates above 5% make the cost of issuing new debt extremely expensive. With $34 trillion in debt, annual interest expenses are nearing or exceeding $1 trillion, higher than defense spending. Tax revenue is forced to fill the bottomless pit. The longer high rates persist, the shorter the fuse on this nuclear bomb. Second, financial internal damage, a chain reaction of small and medium banks. This play saves Wall Street's big banks but is about to break the grassroots small banks. High rates cause commercial real estate valuations to plummet, and borrowers are defaulting on office buildings. Small banks face book losses on treasuries and massive real estate bad debt. Once a chain reaction occurs, the Fed will be forced to print money immediately to save the market. Third, geopolitical rebound, forcing true de-dollarization. Financial weaponization is a double-edged sword. When you harvest others without reservation, they will desperately look for an escape pod. This violently accelerates de-dollarization, central banks selling treasuries, buying gold, and pushing for local currency settlement. This is overdrawing the long-term global reserve foundation of the dollar. Fourth, internal tearing, extreme polarization of social wealth. Tech giants are unaffected, even feasting on the AI frenzy. But ordinary people are drained by mortgage rates over 7% and credit card rates over 20%. The rich see assets appreciate, while the poor can't even make minimum payments. Social conflicts are intensifying. 3. The final outcome, who falls first. The essence of this gamble is to see who outlasts whom. If others' economies collapse first, the US can start cutting rates and complete the harvest. But if America's own commercial real estate and small banks explode first, or interest crushes the budget, the game is over. In this clash of titans, physical precious metals are the ultimate bulletproof vest to escape the paper credit meat grinder. Follow post-sleep intelligence. You sleep peacefully, I'll handle the intelligence.